Hello everyone, and thank you for joining us today. My name is Gillian Hammer, Chief Marketing Officer of Databank. Today I am here with Courage Marty, our Senior Economic Analyst at Databank. He will be giving us a quick recap of Ghana's economy for 2018 and letting us know what we can expect in 2019. Courage, welcome.
Thanks for having me, Gillian.
You're welcome. So we'll get started, and the first question that I have for you is, can you give us an assessment of, or your assessment of Ghana's economy in 2018?
All right, good. To start on a positive note, I think 2018 showed that Ghana continues to make progress in the area of macroeconomic stability. In other words, we've made taking some steps towards achieving price stability and also achieving an increase in the growth rate of our economy. And for every investor, one of the key things that gives them confidence is the stability of the macroeconomic environment within which they are investing. And when we say macroeconomic stability, essentially we are making reference to how stable general price levels are, how stable the exchange rate is, and because it poses risk to the return on investment as well as the capital that has been invested. And so in 2018, on a positive note, we noticed that inflation declined from 11.8% in December 2017 to 9.4% in December 2018. So that's a progress towards price stability, which means also that the risk to returns on investment is lower on that count. We also made good progress in the area of growth. As we noticed, particularly with non-oil growth, we noticed in the third quarter of 2018, non-oil growth accelerated to 8.5% compared to 4.9% the same period 2017.
That's a significant increase.
Exactly. And so it spells good fortunes for the economy going forward. On the external front, there were key challenges, but this has not got to do with development with our domestic policy environment, because we noticed that another progress that was recorded was in the area of our trade balance, where we earned surplus on our trade account. And what that meant was that we earned from our exports more than we spent foreign currency on our imports. And so we had excess, foreign currency. That should ordinarily help support exchange rate stability, But one of the key takeaway from 2018 is that despite these improvements, our economy remains vulnerable to external shocks. And as we saw during the middle of last year to the third quarter of the year, the currency took a downturn because the external environment turned unfavorable, and we saw a lot of foreign investors who invested a lot in our bonds market and stock market started to pull out. And that significant exit or pulling out of our market exerted pressure on our local currency, and that caused some level of depreciation in the Ghana cedi. So the external sector became the major risk that we faced in 2018 and showed how vulnerable our recovery is to external shocks.
When we look into 2019, what are your thoughts? Do we have reason to be hopeful about Ghana's economy for 2019?
Yes, we do, because given the development in 2018, if we adjust or take out the effects of the external sector shocks and the movement in foreign investor sentiment, we notice that the domestic environment showed a marked improvement. Like we saw in growth rate, we are expecting that in 2019, the growth rate will continue to improve, backed by oil production, but as well as a recovery in non-oil sector. And in the non-oil sector, we are expecting that banks will start lending. 2018 was a difficult year for the banks because of the reforms and the recapitalization directive, and that affected negatively the ability to lend. In 2018, we expect banks to emerge from these reforms on a stronger footing, and they should be able to lend more, and that should positively, drive the real sector of the economy in terms of non-oil production. Then you look at government's plan for this year. Government's plan is to expand expenditure in the area of infrastructure development. Now, with that side of things, we are expecting growth in areas like construction. We are expecting growth in areas of supplies, transportation, and logistics, and that should also help boost non-oil growth. With growth in the non-oil sector of our economy, which accounts for nearly 95% of our total economy, what we expect is that should throw up opportunities for jobs, opportunities for higher income, opportunities for investments, and opportunities for higher earnings on investments.
So what do you think are the potential risks to the economy that could actually affect the investment climate in 2019?
The bulk of it will come from the external sector and investor reactions to certain market development. Ghana, for instance, is about to officially conclude its IMF program. Now, the investor community would have a certain view on our impending exit from the program. Their reaction could also mean a certain direction for market indicators like exchange rate and interest rate. And so one of the risks to watch out for is how the market receives the news of government exits from the IMF program, because it could pose risk to currency stability and yields on the market.
So that's the biggest impact.
That's the biggest impact we need to watch.
So what policy measures then can be put in place to help mitigate this risk?
So government has announced a couple of reforms and fiscal legislation. So one of the things that has been passed is the Fiscal Responsibility Act, which has established a fiscal council. What that is supposed to, and of course, in addition to that, there is a cap on the budget deficits, not exceeding 5% of GDP for any given year, beginning 2019. Now, by limiting the budget deficits, it also limits the ability of government to overrun the deficit and cause macroeconomic instability, which will pose a risk to investor returns. So government has assured the market, or is assuring the market, that it is committed to remaining within the 5% limit. And to do that, it has passed a Fiscal Responsibility Act with a fiscal council to ensure that this is followed through. But in addition to that, one of the key challenges is when government will have to finance the deficits by drawing liquidity from the central bank, because it elevates CD liquidity and causes instability in the macroeconomic environment. Government has committed to not taking liquidity from the central bank from now till 2020 ending. And the importance of that is that it helps also limit the risk of inflation excesses, election excesses, And so we think that these reforms should be able to back up the gains that we've made under the IMF program.
Okay. Courage, I'm very grateful. Thank you very much for your insights today. To our listeners, to our viewers, if you would like to get more updates from our research team, I encourage you to visit our website at www.databankgroup.com and visit our research page. You'll get all kinds of reports. So Courage, thank you again very much. I wish everyone a wonderful day.